Hello, I have been trading options for a few years. When I started, I found it very difficult to find the simple basics all in one place. Sort of options for dummies, which we all are at the beginning. I am by no means a guru, so do not take anything I say as investment advice, and do not enter any positions based on any one or two videos you find here. Options have a lot of moving parts, but once it clicks for you, it's pretty simple. So stick with it. You'll enjoy it. Selling a call option means that you are giving someone else the right, but not the obligation, to buy an underlying asset, in this case a stock, from you at a predetermined price, known as the strike price, on or before a certain date, known as the expiration date. If that seems confusing, it is at first. Hang in there. In exchange for this right, the buyer of the call option pays you a premium. Outright selling a single call option is known as a naked call, and very dangerous and not really possible for most of us. More on that in a minute. As the seller of the call option, you have the obligation to sell the underlying asset to the buyer if they choose to exercise their option to buy. If the buyer does not exercise their option, you keep the premium as profit. The risk of selling a naked call is theoretically infinite. If the strike price is $50 and the stock skyrocketed to $200, and your option was exercised, which it most certainly would be, you would have to buy and deliver 100 shares at the market price of $200 each. I don't know of any brokerages that would allow that without a ridiculous amount of capital in your account. There are two ways to sell a call option that would not be naked. One is if you own 100 shares of the stock already and want to make extra income on those shares while they sit growing in your portfolio. That is called a covered call. Two is by selling what is known as a call credit spread, which means, for example, selling a call option at a strike price of $50, then buying another call option at a strike price of $55, or any other amount higher than the strike price you sold. That way your maximum potential loss is limited to the difference between the two strike prices, which in this case is $500. I should add here that once you enter any option contract, you are not stuck or completely subject to fate. There are ways of managing or adjusting any option position. There is always a plan B and probably plan C. Thanks for watching. If you found value here, please like, leave a question or comment below and consider subscribing.